I was looking at this photo the other day, and honestly, I thought my brain was glitching. It's a picture of the Eiffel Tower.
Okay.
It's got the iron lattice, the observation deck, the whole thing. It looks exactly like Paris. But then you zoom out.
And you realize the context is all wrong.
Completely wrong. Instead of the Champ de Mars or, these beautiful Haussmannian boulevards, it's surrounded by what look like cabbage patches and misty farmland.
Right.
And there's nobody there. It's not Paris. It's Tianducheng in China.
Ah, yes, the fake Paris. That's one of the most famous examples of that copycat architecture era.
But it's not just the architecture that's so weird. It's the silence. For years, photos of this place went viral because it was, for all intents and purposes, a ghost town.
Right, a complete replica of a European capital built for thousands of people sitting almost entirely empty.
And it brings up this image that I think a lot of us have when we think about the Chinese economy over the last decade. Massive, gleaming infrastructure, and nobody home.
It's the defining image of the early 2010s, isn't it? The ghost city. You had the new South China Mall in Dongguan. I mean, this place had leasable space for thousands of stores, an indoor roller coaster, gondolas.
Here's the Phoenician in Vegas.
Exactly. But for years, the only thing in the corridors was dust. Or, the most famous one, Ordos Kangbashi in Inner Mongolia, which looked like a sci-fi metropolis, but had virtually zero residents for a long time.
And the narrative back then was pretty straightforward, right? It was, look at this massive bubble, look at this waste. It felt like a house of cards just waiting for a slight breeze.
A spectacular misallocation of capital was the line.
Exactly. But here we are, over a decade later, and we need to figure out if that was actually the whole story. Because the headlines today, Evergrande collapsing, Country Garden, all these mortgage boycotts, the debt crisis, they feel like the sequel to that Ghost City movie.
Well, I'd argue it's not really a sequel. It's the third act of the very same movie. And that's what makes this so difficult to unpack.
How so?
Because you have these two completely contradictory ideas that are both true at the same time. Was that era the greatest housing bubble in human history? Probably, yes.
Okay.
But was it also somehow a successful urbanization strategy that moved hundreds of millions of people out of poverty and built a modern nation? Also, yes.
That's the tension we're digging into today. This is the central paradox. We have a massive stack of sources here: history, economic data, boots-on-the-ground reporting, and we're going to trace the arc of Chinese real estate from, the 1840s all the way to the debt crisis of the 2020s.
And the stakes are just incredibly high. We aren't just talking about empty malls or weird Eiffel Tower replicas. We are talking about where Chinese citizens have parked 60% of their household assets.
60%? Wait, say that again?
60%.
That's staggering. For comparison, in the U.S., what is it?
It's closer to 25%. Or 30%, depending on how you measure it. In China, the home isn't just a place to live. For 2 generations, it has been the primary savings account for over 1 billion people.
So if that market cracks, it's not just a bad day on the stock market, it's a fundamental catastrophe for, Main Street.
For almost every single family. Precisely. So to understand why the world is watching Evergrande so nervously, you have to understand how we got here. You have to understand why a factory worker in a second-tier city would sink every single penny they have and their parents' pennies into an unbuilt concrete box.
Okay, let's rewind then. Because to get to the bubble, we have to start where there was no bubble. In fact, there was no market at all.
Well, that's exactly right. We need to go back to the pre-1998 era. From the founding of the People's Republic in 1949 up until the late 90s, the concept of real estate, as we know it, it just didn't exist in China.
So if I'm living in Beijing in, say, 1980, and I want to move out of my parents' house, I don't go on Zillow. I don't call a realtor.
You definitely don't call a realtor. There's literally nothing to sell. The entire country was in a system of welfare housing allocation. Housing wasn't a commodity you bought and sold. It was a benefit provided by your employer.
My employer? You mean like the factory owns my house?
The work unit, or Danwei. Whether you worked for a state-owned steel mill, a government bureau, or a university, the Danwei was responsible for your entire existence, from cradle to grave.
Wow.
They provided your salary, your health care, your pension, your kids' schooling, and yes, your apartment.
That sounds, on one hand, remarkably stress-free. No mortgage, no rent hikes.
On paper, sure.
Yeah.
It sounds a bit like a socialist utopia. But the reality was a severe shortage economy. Because the housing was free, or at least cost a nominal fee, there was zero incentive for the state to build anything comfortable or, frankly, adequate. It was a cost center for the state, not a profit center.
So what did that look like for the average person? What did it feel like?
It felt cramped. The sources point to these surveys from the late 1970s that are just mind-boggling. The average urban living space per person was less than 4 square meters.
4 square meters. Hold on. A standard king-size bed is about 3.5 square meters. So you're telling me my entire personal existence, my sleeping, eating, living area was the size of a mattress?
Basically, I mean, you'd have entire families, multiple generations squeezed into one room. You'd share a kitchen down the hall with 5 other families. You'd share a bathroom. One of the sources calls it a dwelling narrowness that is hard for us to even imagine today.
So the demand, the pent-up desire for space, was clearly there. People must have been desperate, but they couldn't buy it.
Not until 1998. That's the year everything changed. It's really the big bang of the Chinese property market.
Why 1998 specifically? What happened?
Well, the Asian financial crisis was raging, and China's old economic model was sputtering. They needed a new engine for growth, and fast. The State Council, led by Zhu Rongji, issued a directive effectively ending the in-kind housing system.
So they just pulled the plug.
They pulled the plug. They told the work units, stop building houses for your people. Let them buy their own.
That sounds like a terrifying shock to the system. Hey, you know that free apartment you have? Good luck.
It was a shock. But they softened the blow with a massive one-time privatization scheme. They allowed people to buy their current work unit apartments at incredibly steep discounts.
Oh, interesting.
These were heavily subsidized prices based on seniority, years of service, things like that. So if you were a loyal party member who'd worked at the steel mill for 30 years, you got a great deal.
So it's like the right to buy scheme that Thatcher did in the UK, but on a continental, almost unimaginable scale.
Exactly. That's the perfect analogy. Overnight, millions of people went from being tenants of the state to being property owners. And suddenly, for the very first time, they had equity. They had an asset that could, theoretically, appreciate in value.
And I imagine that just flipped a switch in the collective psyche.
It absolutely did.
Yeah.
It moved housing from welfare to wealth, from right to a commodity.
Huh.
And you have to layer on the cultural drivers here, which are just so powerful. It's not just about money. The sources talk extensively about what they call bachelor's angst.
I saw that term. And the mother-in-law requirement, which I have to say sounds formidable.
It is the ultimate barrier to entry in the marriage market. You have to remember, in China, due to the one-child policy and a lingering cultural preference for sons, there is a significant gender imbalance. There are millions more men of marriageable age than women.
So the dating market is competitive.
Competitive puts it very mildly. It's a battlefield. And in that battle, a house is the price of admission. It's the ultimate signal of stability and success.
So the saying goes, the mother-in-law won't even let you in the door if you don't have a deed to show her.
That's not even an exaggeration. If you are a young man and you don't own property, you are effectively invisible to many prospective brides, and more importantly to their mothers, who often have the final say. The apartment is for her daughter's security.
So you have this intense social pressure you must buy to get married. But then there's the investment angle. You mentioned earlier that 60% of assets are in housing. Why not buy stocks? Why not bonds or mutual funds?
Because for most of this period, those markets were either underdeveloped or seen as incredibly risky. The Chinese stock market, especially in the 90s and 2000s, has historically been treated like a casino.
Not a place for your life savings.
Absolutely not. It's incredibly volatile, was rife with insider trading, and retail investors, the so-called leaks who get harvested, often get burned badly.
And what about investing overseas?
The Apple controls. You can't just take your life savings in yuan and go buy Apple stock or U.S. Treasury bonds easily. There are strict limits on how much money you can move out of the country.
So your money is effectively trapped in the country. The banks pay terrible interest rates, often below inflation. The stock market is a gambling den.
So what's left? Where do you put your money to save for retirement or your child's future?
Concrete.
Concrete. For 20 years, from roughly 2000 to 2020, property was the can't-lose piggy bank. It was the only major asset class that seemed to go up year after year without fail.
And that belief that property only goes up is a hell of a drug. Which brings us, I think, to the bubble era, roughly 2005 to 2011.
This is when things went completely parabolic. The sources indicate that average housing prices across the country tripled between 2005 and 2009.
Tripled. In 4 years? That's Bitcoin-level growth for a physical, illiquid asset? That's insane.
And you have to remember the global context.
Wow.
2008 was the global financial crisis. The rest of the world was melting down. Lehman Brothers collapsed.
Right, the world was ending.
But China, in an effort to insulate itself, responded with a massive stimulus package, a 4 trillion RMB package, plus a huge expansion of bank lending. They flooded the economy with cheap credit to keep growth alive.
And all that money had to go somewhere.
And it went directly into real estate. State-owned enterprises, local governments, private developers, everyone gorged on cheap credit to build, and regular people borrowed whatever they could to buy.
But wait, here's the part my brain gets stuck on. If prices are tripling, and wages are clearly not tripling, how are people paying for this? The math just doesn't seem to work.
The math gets very, very scary when you look at the price-to-income ratios. In international economics, there's a general benchmark. A ratio of 5 to 1, meaning the median house costs 5 times the median annual household income, is considered severely unaffordable.
Okay, 5 to 1 is the red zone. Where was Beijing? Or Shanghai?
At the peak of the bubble, in the Tier 1 cities like Beijing, the ratio hit 27 to 1.
27 years of a household's entire income. That's essentially a lifetime of labor for a 2-bedroom condo. How is that even possible? Who is buying these places?
Well, this is where we have to talk about something the official data doesn't capture. We have to talk about gray income.
This is the theory from the economist Andy Shi, right? He was a bit of a contrarian voice at the time.
A very loud and often correct one, yes. Andy Shi is this brilliant independent economist who looked at the official data and basically said, this is nonsense.
What was his argument?
He said, look, the official income stats say people can't afford these homes, but the homes are selling, often for cash, so the money must be coming from somewhere else.
And somewhere else was.
Off the books. Undisclosed income. This could be corruption, kickbacks, undeclared business profits, consulting fees paid in cash, red envelopes filled with money. Shi estimated that this gray income could account for as much as 10% of China's entire GDP.
A tenth of the economy was just shadow cash.
Potentially. He famously would do these very unconventional analyses. He'd sit in hotel lobbies in the Yangtze Delta and just count the traffic or look at electricity usage versus reported factory output. And he concluded there was a massive shadow economy flooding cash into real estate in the big cities.
So the guy buying the $2 million apartment in Shanghai officially makes, say, $50,000 a year as a civil servant, but under the mattress, he's sitting on a pile of cash from, let's call it, informal business activities.
That's the theory.
Yeah.
And that cash needed to be laundered or at least stored somewhere safe where the taxman couldn't see it. Real estate was the perfect bolt. It was tangible.
And the speculation got so crazy that even non-real estate companies started pivoting, didn't they? I remember reading in the sources about shoe companies getting into the game.
Oh, that is the classic textbook bubble signal. You had manufacturers of shoes, cigarette lighters, chemicals, boring, low-margin industrial businesses suddenly opening property divisions.
Why would they do that?
Because why would you grind out a 3% profit margin making sneakers when you can borrow cheap money from a state bank, buy a plot of land, build a tower, and make a 30% or 40% return in 2 years? The incentives were completely skewed.
It reminds me of the dot-com bubble when every company added .com to their name, or more recently when everyone suddenly became an AI company. When the shoe factory becomes a condo developer, you should probably run for the hills.
And to be fair, the government tried to stop it. They weren't completely blind to the risks. Around 2010 and 2011, they actively tried to deflate the bubble, but gently.
How? What did they do?
They started putting the brakes on. They raised down payment requirements, especially for second or third homes, up to 40%, 50%, even 60%.
That's a serious barrier.
A huge one. And they did things like banning non-residents from buying property in Beijing unless they'd paid taxes there for 5 consecutive years.
That's drastic. Imagine if New York City said, unless you've lived and worked here for 5 years, you literally cannot buy an apartment. The market would seize up.
And it did, temporarily. It cooled the market. Prices dipped or flattened in 2011. But the economy's dependence on real estate was already too deep. The moment overall GDP growth slowed down in 2012, the government would panic and quietly loosen the rules again. It was an addiction they couldn't kick.
And while this absolute frenzy was happening in the major cities, out in the provinces, we started seeing the phenomenon we opened with, the ghost cities.
Yes. And this is genuinely one of the most misunderstood parts of the entire story.
Misunderstood how? I mean, we've all seen the videos. Miles of empty 6-lane highways, gleaming skyscrapers with no lights on. That seems pretty clear-cut, doesn't it?
It seems that way on the surface. But we have to look at the timeline. Take Ordos Kangbashi, the poster child. When Al Jazeera's Melissa Chan went there in 2009 and made it world famous as a ghost town, the city was practically a newborn. It was only 5 years old. Construction had just started.
So you're saying we're essentially judging a construction site and calling it a failure.
We were judging a different model of urbanization. In the West, we generally build demand-led. People move to a suburb, traffic gets bad. Then, maybe 10 years later, we get around to widening the road. We build the school after the classrooms are already overflowing.
Which is incredibly annoying, by the way.
It is. It's inefficient. China operates on a supply-led model. They build the infrastructure, the 6-lane highways, the grand government centers, the universities, the high-speed rail station first. Then they expect the population to fill it in over the next 10 to 20 years.
The field of dreams model. Build it and they will come.
And you know what? In many of these famous cases, they did come.
Really? Ordos isn't empty anymore.
Not at all. Ordos Kangbashi now has a population of over 150,000. It turns out they built some of the best schools in the province there, which acted as a magnet for middle-class parents. Housing crisis rebounded. It's a functioning, vibrant city.
Okay, what about the Zhangdong New area? That was the one that the show 60 Minutes just roasted in 2013. They had that classic segment with the empty towers and deserted plazas.
I remember it well. But if you go there today or look at the 2023 data, that ghost city has 1.3 million residents. It's a major financial and logistics hub for central China. It's bustling.
So the Western media was just wrong.
I think we were impatient. We looked at a 20-year plan in year 3 and called it a failure. Wade Shepard, an author who wrote extensively on this, has a great line. He calls it calling the game at halftime.
However, I mean, surely they can't all be success stories. You don't build an estimated 65 million empty homes, which is the number from a 2020 study, without some significant waste. That's enough to house the entire population of France.
Oh, absolutely. And this is where we need to make a critical distinction. There's a difference between a city that is growing into its skin and a development that is just structurally useless. There are plenty of remote, poorly planned developments that never filled up and probably never will.
Right.
But even in the successful cities, you have this other phenomenon of millions of sold but empty units.
This is the weird part to me. I buy a house, but I don't live in it. I don't even rent it out. Why?
It goes back to that investment mindset we talked about. If you buy an apartment as a store of value, like it's a gold bar with windows, you don't necessarily want tenants in it.
Why not? That's income.
Tenants wear things out. They
Sure.
scratch the floors, they scuff the walls, they break things. In the Chinese market, a lived-in secondhand apartment often has a lower resale value than a pristine, untouched shell.
Wait, a rough shell. What does that mean?
Yes. In China, it's very common for apartments to be sold as concrete shells. No floors, no toilets, no drywall, no kitchen cabinets, just the box. The buyer is expected to fit it out themselves.
So people buy the concrete box and just let it sit there.
For 10 years, yes. It's literally a concrete safety deposit box in the sky. It's a way to park your savings for your child's future marriage or for your own retirement. Occupying it would devalue the asset.
That's a completely alien way of thinking about housing to me. And this led to some truly bizarre marketing tactics to sell these remote, empty developments, didn't it? We have to talk about the rent-a-foreigner industry.
I was hoping we'd get to this. It sounds like a crazy urban legend, but it was very, very real.
So what was it?
Well, you have developers in these 3rd or 4th tier cities, basically in the middle of nowhere, and they want to project an image of international success. They want to tell the local farmers and small-time investors, this isn't just a building in a field, this is a global commerce hub.
Okay, a classic marketing pitch. So how do you prove that?
You import white people. Seriously. If you were a Westerner in China in the early 2010s, a student, a teacher, a backpacker, you could pick up these weekend gigs. You put on a cheap suit, go out to some remote development, and stand at a ribbon-cutting ceremony. The developer would introduce you as a famous architect from Canada, or a diplomat from France, or the CEO of an American investment firm.
They just paid you to stand there and look foreign.
Yes. One of the sources describes it as creating an erotic fantasy of internationalism and success. It didn't matter if you were an unemployed English teacher from Ohio. If you had the right look, you were a prop in the sales pitch to convince locals that this place was the next big thing.
That is hilarious and also incredibly cynical. It's selling a dream that is literally built on a lie.
But that lie, or maybe that belief that growth is inevitable, wasn't just marketing. It was baked into the very structure of the government. And this is the most critical part of the deep dive, I think. We have to talk about the engine under the hood. Land finance.
Okay, lay it on me. I hear this term land finance all the time. What does it actually mean in simple terms?
It answers the fundamental question. How do local governments in China pay for anything? In the US or Europe, your town pays for schools and police and roads mostly through property taxes, right? You own a house, you pay the town a percentage of its value every single year.
Right. Everyone hates it, but it pays the bills.
Well, for this whole period, China didn't have a recurring annual property tax like that. And the central government in Beijing takes the lion's share of other taxes, like income tax and VAT. So the mayors of these cities are, on paper, broke.
But they have one massive asset.
They have the land. In China, the state owns all urban land. So what a local government can do is rezone agricultural land on the edge of the city, evict the farmers, compensate them, and then sell the long-term land use rights to a developer like Evergrande.
And because land prices were skyrocketing for 20 years, this was a gold mine.
Here's a printing press. In some peak years, selling land accounted for 50%, half of all local government revenue. Now, just think about that incentive structure for a minute.
If half my paycheck depends on selling land at ever higher prices, what am I going to do?
You're going to do everything in your power to make sure land prices stay high. You're going to encourage developers to build as much as possible. And you're going to borrow against that future land revenue to build shiny new subways and parks and convention centers to make the land even more valuable.
It's a self-reinforcing cycle, a feedback loop.
A very dangerous one.
Mm-hmm.
And it gets even more complicated. The local government creates a shell company. It's called an LGFV, or Local Government Financing Vehicle. This LGFV borrows billions from state banks to clear the land and build the infrastructure. Then the government sells the land to Evergrande. Evergrande, in turn, borrows billions to buy the land and build the apartments.
Everyone is borrowing. The whole system is built on leverage.
Everyone is borrowing. And the collateral for all of it is the single foundational assumption that land prices will keep going up forever.
And what about the politicians, the city mayors? Where do they fit in?
Their promotion within the Communist Party depends almost entirely on hitting GDP growth targets. And what's the easiest way to generate massive GDP? Pouring concrete. So if you want to get promoted from a provincial city to a job in Beijing, you sell land, you build a massive new district, you juice the GDP numbers for a few years, and you move up the ladder long before the bill for all that debt comes due.
It's a giant game of musical chairs.
Precisely. And in August 2020, Beijing decided the music had to stop.
The three red lines.
The three red lines. This was not an accident. This was not a market crash in the Western sense. This was a deliberate policy decision by the central government in Beijing to finally defuse the bomb. They looked at the balance sheets of developers like Evergrande, who had hundreds of billions of dollars in debt, and said, this is a systemic risk to our entire country.
So what did they actually do? What were the red lines?
In August 2020, they issued 3 strict rules. If a developer wanted to borrow more money from any bank, they had to meet 3 specific financial health metrics. There were basically limits on their debt-to-cash ratio, their debt-to-assets ratio, and their debt-to-equity ratio.
And Evergrande.
They failed all 3. Miserably.
So they were cut off. The banks were ordered to turn off the credit tap.
Completely cut off. And you have to understand, the business model for Evergrande and many others was in some ways like a Ponzi scheme. They needed to take out new loans just to pay the interest on their old loans and to start new projects. When that liquidity tap was turned off, they suffocated almost instantly.
And this brings us to the most tragic part of the collapse. The victims who weren't bondholders or shareholders, but the regular home buyers, the pre-sale model.
This is where the technical details really matter. In the West, if you buy a condo that isn't built yet, you typically put down a deposit, maybe 10%, 20% if it's a luxury building. You pay the rest when the building is finished and you move in.
Right. That seems logical.
In China, the standard practice was to pay 100% of the purchase price up front. You take out a 30-year mortgage for the full amount before the ground is even broken.
Wait, hold on. Let me get this straight. I'm paying a full mortgage principal and interest every month for an apartment that is just a drawing on a piece of paper.
Yes. The developer takes your money and supposedly uses that money to build your house. But in reality, what they often did was use your money to go buy more land to start the next project to keep the Ponzi scheme spinning ever faster.
So when the 3 red lines hit and the developer's cash flow dried up,
The construction stopped. All across China, cranes just went still. And you now have millions of people, regular middle-class families, paying mortgages on rotting concrete skeletons that might never be finished.
That is horrifying. I can't even imagine. You're trapped, you can't live in it, you can't sell it, but the state-owned bank still wants its monthly payment.
And that's what triggered the mortgage boycotts in 2022. It was a rare, widespread act of civil disobedience. Groups of homebuyers and hundreds of projects across the country banded together online and said, "We are stopping payments. If you don't build the house, we don't pay the loan."
Which is a direct threat to the stability of the entire banking system.
It terrified the government. Social stability is the #1 priority. If millions of people start defaulting on their loans to the big state banks, the banks could collapse. That's a true systemic crisis.
So where are we now? It's 2024 or 2026 as we record this retrospective. The dust is still settling. What is the state of the market?
The sector has shrunk dramatically. Real estate and related industries used to be, by some estimates, a quarter, 24% or 25% of China's entire GDP. Now it's dragging significantly lower, maybe 19% or even less. That is a massive, gaping hole in the economy that nothing has yet been able to fill.
And the wealth effect you mentioned earlier.
It's gone into reverse. It's a negative wealth effect. People feel poorer. If your apartment, which is 60% of your family's net worth, has lost 20% or 30% of its value in the last 2 years, you aren't going to buy a new car. You aren't going to go on a fancy vacation. You're going to save every penny you can. Consumption is very weak.
Is the government bailing them out? Are they coming in with another huge stimulus?
It's a very cautious, very targeted bailout. Xi Jinping has this famous mantra: houses are for living, not for speculation. And unlike in the past, they're actually sticking to that. They are not flooding the market with cheap cash like they did in 2008 or 2015.
So no bazooka stimulus this time.
No. They're doing very specific things. There's a white list of certain development projects that they've deemed worthy of saving. They're telling banks to lend to those projects, but only so they can get the homes finished and give the keys to the people who already paid. It's about preventing riots, not reinflating the bubble.
And they are lowering mortgage rates and down payments a bit, right?
Yes, they're trying to entice new buyers back into the market, but it's a slow grind. They're trying to let the air out of the bubble without popping it completely and causing a full-blown financial collapse. It's an incredibly painful, multi-year process.
And what about the local governments, the ones who are addicted to selling land?
They are in a deep crisis. Developers aren't buying land anymore because they're bankrupt or scared.
Yeah.
So local government revenue has absolutely plummeted. We're seeing these bizarre reports of LGFEs buying their own government's land, literally moving money from one government pocket to another just to make the numbers look like the market is still moving.
That's just fake revenue. It's an accounting trick.
It's an act of desperation.
Yeah.
But the biggest damage, I think, is psychological. The iron law of Chinese real estate, the unshakable belief that prices always go up, is broken. Once you shatter that faith, it is incredibly hard to rebuild it. People are now looking at housing as a risky asset, not a safe haven. That's a fundamental shift.
So as we wrap up this deep dive, how do we synthesize this whole incredible story? It feels like a story of just immense ambition that flew too close to the sun.
I think that's a good way to put it. It really is the story of modern China in a microcosm. It's a story of incredible, breathtaking transformation. We have to give credit where it's due. This system urbanized a country at a speed never before seen in human history. It raised the urbanization rate from 18% in 1978 to over 64% today. They built world-class infrastructure. The ghost cities did eventually house millions and millions of people.
But the bill has arrived. The model is unsustainable.
The bill has absolutely arrived. The model of growth at any cost, of building just to hit a GDP target, regardless of real demand or financial risk, has hit a hard wall.
You know, there was a point in the research that really stuck with me. It wasn't about the economics. It was about the physical quality of the construction.
Yes, the so-called tofu dreg construction.
Right. But not just the shoddy stuff. It was the idea of planned obsolescence. Some of the architects quoted in the sources say that many residential towers in China are designed and built to last maybe 20 or 30 years.
That's right. In Europe, you build a cathedral or a stone house to last for centuries. In the boom years of China, you built it to get it sold and to hit this year's GDP target. Long-term quality was a secondary concern.
And here's the provocative thought I want to leave you, the listener, with. In our current global economic system, if you build a tower, that activity adds to GDP. 20 years later, if that tower is crumbling, you have to tear it down, the demolition also adds to GDP, And then if you build a new one in its place, that adds to GDP again.
It's the broken window fallacy on a macroeconomic scale.
Mm,
You're just churning activity for the sake of a number.
exactly. So if a huge chunk of this miracle growth was based on churning concrete building things that are destined to be rubble in a single generation, how much of that wealth was actually real?
It forces us to ask, what is the purpose of an economy? Is it to generate a number on a spreadsheet that makes politicians look good, or is it to create lasting, durable value for human beings?
Is the ghost city a bug in the system, a mistake? Or is it actually a feature, the perfect symbol of an economy that became obsessed with the wrong metrics?
That is the multi-trillion-dollar question
Yeah.
that China and maybe the rest of the world is going to have to grapple with for the next decade.
Something to chew on. That's it for this deep dive. Thanks for listening.